Hi, everybody. Good to see you here. Welcome to this VC Lab webinar. My name is Mike Supervici. I am the head of acceleration here at Desol Group. For those of you who are not familiar with us, Desol Group's whole entire purpose of existence as an organization is to help new and emerging managers thrive. Okay, and we do that in a couple different ways. We have a very, popular program called VC Lab, where we help new managers and emerging managers launch their funds. I'm going to talk about that in a little bit. We also do the same thing for limited partners. We do the same thing for folks that are trying to break into the asset class with our Venture Institute program. We also have a set of tools and systems to help make this process even easier for folks. We built a product called Desol Hub, which just become the operating system for venture capital. Roughly 700 venture capital firms use it. We have an entire back office and fund administration business line with a very high NPS that's typically ranging in the mid 80s to 90s. And finally, we know that fundraising is brutal, right? And so we have a fund of funds, we have an entire capital network, and so on. So the whole purpose of everything we're doing is, if you can sort of see how we built this out, is just to try to make this process easier to help new and emerging managers thrive. Okay. What we wanted to do, though, and probably one of the best ways that we've been able to help the entire ecosystem and the world, is just through webinars like this, though, where we just talk about basics, talk about things that a lot of people don't know, because a lot of the information that you read online about venture capital is just not very accurate. So what we want to do is spend these sort of sessions, and we do roughly one of these a week, just going over best practices, things to think about, and really just opening this up to an AMA. So if this is your first time joining us on a webinar like this, there's a webinar chat, which you can see on the right-hand side of your screen. A lot of people are starting to introduce themselves. Please introduce yourself. Just a quick note, though, for everybody, this is a public webinar, okay? And so just be careful, okay? Don't put your thesis and what you're working on, because that is a general solicitation risk. So don't say, hey, I'm working with and building this fund that's investing in these companies in this place, okay? Because again, general solicitation risk. Also, there's a Q&A button at the bottom of your screen. It's got a little question mark on it. And so after I sort of finish this presentation here, make sure that you can ask questions, and you can ask me questions about anything, okay? The topic of today is LPs and LP archetypes. You get a lot of questions about this because the way you kind of manage LPs is very different depending on what they do and the type of LP they are, and so on. And so what I wanted to do today is give everybody a little bit of clarity on LP archetypes, how to think about them, how to target them, when to target them, and stuff like that. It's going to be roughly 10, 15 minute, maybe 20-minute presentation. Then I'm going to take the deck off the screen, and then I want to sort of get into all of your questions, okay? So let's go ahead and get started. All right, LP archetypes, okay? So before I go deeper on this, look, it's really important if you're fundraising to sort of have almost like a persona. It's not really that different than marketing persona for the marketing people on the call today, and the different type of persona requires a different strategy. I don't know, if you're going to do an enterprise sale that requires multiple key decision makers, that's typically a year to 2 years, right? There's a different process there than, I don't know, purchasing something off of a Shopify website, right? And so it's just a different profile, And so you want to sort of think about LPs in the same way, so that you can tune your message in the same way, so you can kind of go after these folks at their appropriate time. Okay, so let's just start with the primary source of capital for the vast majority of new and emerging managers, which are what are called high net worth individuals. Okay, again, for those of you that are a little bit newer to this, just know that other types of LPs, the more bigger, more infrastructure, more what I would sort of call like sophisticated, for lack of better words, the bigger they are, the more likely they are to have preventions in their charter, okay, from backing new and emerging managers, because they find new and emerging managers as being risky. I don't make the rules. I don't think this is right. I'm trying to fix this. We're trying to fix this as an organization, but this is sort of like the world that we live in. So this is why the vast majority of people raising a fund one and often even a fund two are going to get a huge component, if not most of it, from what are called high net worth individuals. Okay, these are angel investors. Bucketed them here as operators. Any sort of executive at very large companies typically will qualify as an accredited investor here in the United States. There's various accreditation rules as well in other countries, but the way you sort of want to think about this is that wealthy people. Okay, that's how you sort of want to think about this. It's not like rocket science, but there are certain profiles that you will tend to do a little bit better with than just randomly wealthy people. And I've listed them here, right? So you've got angels, operators, a lot of founders that have been successful in the past, that have maybe taken venture capital as well. That is also, something to kind of think about. And then of course, like there's like domain experts, right? Like people that really understand your thesis and also happen to be wealthy at the same time. Those tend to convert really well. Of course, there's a large gamut of high net worth individuals, but some you will struggle more with. So, for example, like if a person made all of their wealth in I don't know, natural resources or real estate and have like little to no exposure to venture capital, to technology, to anything like that, that's a much harder that's just a much harder path to convert them, right? Just because they don't know what you're working on and what you're doing. So now you got to like educate them, completely different risk profile and so on. So it's going to be a little bit more difficult. Okay. That being said, if you sort of find the right type of high net worth individual, you are going to just be able to convert them pretty quickly. So it typically takes folks like this, like one meeting to make a decision, right? Because it's their money. And so they don't have to go and check with other people or whatever, like, maybe a family member or something, but like it's generally a very fast process. And so therefore you're going to have a very different style of marketing flow because it's just a much faster process. Okay. The second big bucket of, sorry. One thing about high net worth though is that, look, the reason that they're investing, yeah, sure, there's a performance component to this, but it's not just performance. This is another thing I also see people like, it's like, oh, like, well, you can get performance in other ways too, right? Like you can put money in crypto or whatever, right? It's more that there's an access component to venture capital. There's maybe just a passion about the thesis. Like, I don't know, maybe you're working on clean tech or something. They're really into like trying to push clean tech innovation forward. So there's always more than just performance with high net worth individuals. They want to be part of a community oftentimes, and so all of those play a major factor in how you sort of convert these types of folks. All right. Next up are what are called like family offices, okay? And there's so many flavors of family offices. I'm just, if you do a quick Google search, you'll probably get way more than what I'm listing here on my thing. But I'm just telling you, this is just a high level sort of overview of the folks that tend to, you tend to have a better probability with in general. And it's, I've listed them here from like easiest to like way harder. So for most people in fund ones and fund twos, there's really one type of family office that tends to invest the most, which are what are called single family offices. So the way you want to think about these is that it's effectively a high net worth individual, right? That is just getting to that level of wealth where they need either a person on a part-time basis or maybe a full-time basis to manage all of their assets. But they're still largely like the decision maker. So the marketing flow is a little different, but not that different than a high net worth individual. And then, after that, they get bigger and bigger, and then it gets harder and harder for new and emerging managers to convert. So next up are what I call multifamily offices. This is for very large type of wealth management and things like that. Lots of process, lots of teams, lots of decision makers. Okay. Hybrid is kind of a somewhere between sort of like a multifamily and single, maybe some infrastructure, but maybe a little bit more control for the person. And of course, there's all these concepts around outsource. You probably have heard some of these, like, hey, I'm going to outsource to this like one manager that runs a whole bunch of these together. And those are the hardest ones, right? Because they're the most like risk averse. So the way you want to think about this is that single is like easier because they're not they make their own decision. And the more you go multifamily, hybrid, outsource, the higher the level of complexity, the number of people you got to convince, and therefore the more risk averse they are, right? Because you're dealing with employees and they can't like have like green lighted an investment into something for an individual, and if that investment went like to zero or something, you know, they're going to be partly responsible for that, and that's bad for them. So they're just going to put you through a ringer. And often they're going to ask you for things that you just can't provide because you're a fund one or a fund two. You really don't have track record because you haven't been in business long enough. And so typically you end up seeing like fund three, fund four level people, kind of going after the multifamily hybrids and outsourced type of family offices. Okay. Family offices, though, especially the single family offices, they primarily invest for like deal flow purposes. They want to have opportunities. So like a lot of times the family office will make an investment in your fund just so they can have priority to double down on your pro rata or your co-investment follow-on opportunities. And this is why people with small funds actually do really well with family offices, because it's a kind of a pretty straightforward pitch. It's like, hey, we have a small fund. We're not going to have reserves, really. We're not going to be able to like deploy a lot of the fund to double down on our winners because it's a small fund, $5-10 million, whatever it may be. And so all of the investments that are coming out as part of this in the future, of like that I'm getting to the next level, where you're going to get priority. And so you're going to get basically Series A and Series B deal flow that you probably couldn't get into family office because you don't have a relationship. And you're going to be able to put a pretty big slug into one of these companies. That's a pretty compelling thing, They're also building a lot of relationships because they want to know certain things. Like maybe they're like really interested in a specific area, and things like this. So building a relationship with lots of potential partners in the field makes sense. Some of them are super strategic, like, hey, we're a big, supplier of blah, 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 so they may want to invest in some CPG funds because it's like really helpful to their business, so that's another way to kind of think about this. And finally, a lot of times is like research, right? So there's a big sort of what I would call generational transition in lots of these family offices where, a lot of the heirs, the younger generation is taking over. They're like really more interested in tech than some of the others, than their parents and stuff like that. And so it's a really good way for them to sort of stay on top of what's going on, what are the trend lines in AI and stuff like that, and learning from the people on the ground, and investing and getting your reports and talking to you and doing calls with you is a really good way to know that. Okay. So that's sort of how family offices operate. So like your pitch to them is very different than a high net worth. The high net worth is like, do I believe in the GP? Is this something I care about? Is this a community I want to go? Here it's like, hey, I have a lot of deal flow. You get to get into like my best companies and so on. You have these relationships. You can kind of build off that. So it's a very different sort of perspective. And finally, like the hardest of the hardest, very rare that institutional LPs come into fund ones. They're exactly what the name says. They're just like super robust investment institutions that invest in alternative assets. Okay, they invest in fund managers, And a lot of them are kind of part like all bucketed, obviously, like endowments, pension funds, sovereign wealth funds, that level folks. Corporations can be here. They could arguably also get their own slide, but they kind of have there's from a timeline perspective, it's still sort of similar. I've also listed them in a way that's like from like what's the hardest to easiest to hardest in a way. Like corporations are like the easiest of the hardest right now for you because sometimes they have a strategic initiative that they care about, and so you may be able to get a corporate to come into your fund. But endowments, pension funds, sovereign wealth funds, basically they don't do emerging managers in general. So really you're looking at these at like fund 4. Some of you are going to get some of these at fund 3. Some of you might get a foundation or two in a fund 1 or a fund 2, but their requirements are crazy strict. Okay. And the reason that they're crazy strict is because at the institutional level, performance is just not enough. They need predictability and performance. Okay. Because again, you're pitching employees, they're risk averse. They want to make, they cannot, they would rather be in like a safer bet versus one that has a lot of upside and a lot of potential for failure. And, it's like really robust, like reporting and things like this that they need in order for them to sort of operate. So they're going to require you to do that. And so at this next level, okay, is, you want to make sure that, you have like full on like institutional grade operations. You've had some sort of track record and things like this, because again, they need predictability and performance. Okay, predictability and performance. I can't stress this enough. Again, are there some types of institutional LPs that invest in new managers and stuff like this? Sure, typically they tend to be like foundations, but you're still looking at like a 1 to 2 year cycle because you have to go through committees, right? You have to like get lots of people to sort of agree to invest in your fund. And it's a pretty tough thing to do, right? It's pretty tough to get consensus to invest in a kind of new fund with little track record. And so many of them don't even look at it. Also, they're trying to put a lot of money to work, and most small ones can't even take that money, even if they were to change the strategy. Like very few people could even handle taking on that kind of capital or that kind of, that kind of control. Okay. And so just something to kind of think about this, this is like, it's okay for you to start having conversations with them, but just know that you're building these relationships for them to potentially come in 3 to 4 years from now, like it's at that level of relationship building. Now, look, with each of these types of, prospects, you're going to have a different process. So where I see a lot of people get hurt is that they try to put a family office, or even worse, an institutional, through a process and flow cycle that they would use on a high net worth individual. And that's just going to backfire. So, what I'm showing up here, this is a very typical process that we see. Like, let's say you have a lead, they express some interest, you do a call, they sign a pact. For those of you who don't know what a pact is a non-binding letter of intent that you can send to LPs to sign, to hard circle them. Then maybe you send the materials, then you send the docs and you close them, right? It's like one call close. Like most of these people are so busy, they don't want to talk to you multiple times. Like, I don't know if you're pitching some executive at Snowflake or whatever, they don't have time, man, right? So they're going to make a snap decision on one call. Okay. That's not going to be the case for family office, right? Like you're going to have to go through a series of steps, multiple meetings oftentimes. They're going to want to look at data. They're going to look at your portfolio to see that it's actually really, really good portfolio. And maybe then they'll sign a pact. At the institutional level, there's no concept of a pact, right? Because you're running through multiple committees, multiple processes, multiple things, and stuff like this, and multiple decision makers, multiple forms of compliance and legal DD. It's like a super long, drawn out process. Okay. And so you are in their funnel versus them being in your funnel. So this is the biggest differentiation between high net worth, family office, and institutional. With high net worth, they're in your funnel. You can use pressure, you can use news, you can use a lot of things to sort of make people move because it's an individual decision that you can influence and it's their money. In family offices and institutionals, you're in their process, you're in their funnel. You have to kind of follow their requirements to kind of get to the step. And it's really hard for you to sort of move that up. There are some things you can do, but it's very, very hard. Okay. And so I think I'll end here. I think I've given you enough here to sort of build a discussion. I already see that there's a lot of folks here that have had questions in the Q&A. So for everybody that joined a little bit late, there is a Q&A button at the bottom of your screen. If you can go ahead and just put some questions in there, upvote them, I would appreciate it as well. Not really monitoring the chat. I do see that some people came in a little late and maybe they didn't get the message from me, but guys, I'm going to delete your message, Nicolo. Do not talk about what you're working on. This is a public webinar, okay? That's a pretty serious, general solicitation risk. Do not put, hey, I'm running this fund that does XYZ. That's general solicitation. Don't put that in. You can say, hello, I'm Mike, here's my LinkedIn, but that's about it, okay? All right. So I'm going to go ahead and go into the questions here. So I had an epiphany. Is it too late to completely change my fund focus and subsequently my fund thesis? This is kind of a broad question, Timothy, so I'm not sure where you're at in the process, but let's just assume that you've just started. I don't know, maybe you're even in cohort 19 or something that's ongoing right now. Well, it's totally fine, right? That's not a problem. You should do that, and you will do that. Even after you do a closing on your fund, it's normal for people to sort of evolve their thesis a little bit as long as it's still the same direction. What you don't want to do is just, Eli, dude, did you hear what I said? Like, stop talking about what you guys are up to. You can't talk about your fund publicly. Like, literally. All right. I just deleted your message. All right. Dominica, if we see more of these, we can just like remove them from the webinar because I don't. So anyways, all right. So Timothy, back to you. Even after the first close, you can sort of evolve the thesis a little bit as long as it's basically the same. What you don't want to do is be like, hey, I'm running this crypto fund that's doing XYZ. And then you basically do a first close on that. It's like, hey, I'm going to change to something like radically different, like climate tech. Then you're kind of screwed. Okay, you're kind of screwed, right? And your LPs are going to be super upset. They're not going to be happy with this. So just that's what you want to do, with this kind of stuff. Okay, so like just be very careful. Like don't go too much, and just that's how I would handle this. Okay. All right. What are the differences between VC Lab and Venture Institute? So VC Lab is a closing program. Is designed to help launch your fund and get you to a first close as quickly as possible. Venture Institute is a program that's designed. Hey, Dominica, there's people spamming the chat. Let's go ahead and remove them from the call. So with Venture Institute, what you want to do is the way you want to think about this is that it's a training program to help you like learn about all aspects of venture capital, right? It's not really, it's educational and it's not really like, hey, you're going to close a fund in 3 months. So VC Lab, you're going to close. It's like you have to close to finish the program. You're going to get commitments within weeks of starting the program from limited partners. Okay. So it's very practical. You're going to close. Like with Venture Institute, it's like, I want to learn about, I want to learn about the program. I want to learn about how VC works. It's really designed to help more people break into venture capital, to be associates in funds. Sometimes people go into Venture Institute and end up launching their own fund too, but it's more like an ecosystem sort of development. What differences do you see between LP archetypes behaviors in different cultures? Um, so at the institutional level, there's actually and family office level, it's not that different between cultures, to be blunt. It's more at the high net worth individual level where you get the most differences culturally, right? Because in many regions, a lot of high net worths just don't have as much exposure to high growth, high tech type of innovation, and they tend to be more conservative or tend to have made money in different areas. So it's harder for you to kind of tell them why venture makes sense. At the other levels, it's not that different, honestly. It's true that in other places in the world, um, the family offices or even the institutionals are a bit more conservative than in places that have had a vibrant venture ecosystems like the United States, and they force managers to go through even more hoops, right? So you'll see like a lot of like development banks that are funding managers in emerging markets and things like this. Very, very difficult. But the reason they kind of have to do that is more like CYA, right? There's just a lot of like bad behavior that happens, not because people are bad, but because there's not a level enough of sophistication on basic things like compliance that they have to like start dealing with that through diligence and the legal docs and things like that, you know. All right. Does having high level advisors help with attracting institutional LPs? Think executive level, federal admins, former unicorn founders, etc. No. So Troy, basically, like the LPs invest in the manager. Full stop. This is kind of like the difference with like say like starting a company versus starting a fund. In a company, you got this product, you've got all these things going on. In a fund, it's all about Troy, like, and you're the one making the decision. You're basically a professional money manager. And so what they want to see is what you've done in the past, to help them determine that you can potentially do similar or better in the future. And to get comfort with that, they're going to put you through a ringer if you even qualify to, a lot of times they won't, they're like, just to flat out tell you, like, we're prevented by charter, or they'll just pass because they are prevented by charter from investing in new managers with no track record. It's just like a huge risk for them. And a lot of people don't want to take that. And so, but yeah, it's not like there's things you can do. So for example, having a super professional, a back office fund administration and legal firm kind of operation helps a little bit, but ultimately it's still going to be about Troy, sadly, right? And that's why a lot of these folks are just, unless they have specialized programs that are designed to invest in new managers, like, speaking of institutionals, Decile Capital, it's a fund of funds that we have that does nothing but new and emerging managers. Unless they have a program like that, it's just super hard. So the best thing you can do is be like, do you have a program for investing in emerging managers? And if they say no, you're like, oh, probably not going to work here for now. What's the demographics split of successful funds raised via VC Lab by race and gender? We've done some studies of this, primarily on gender. It's super hard for us to do anything like beyond that, though, Moses, because we're so international. Like, I don't know, man. It's really hard for me to ask a question about race in a certain continent where that race is dominant, right? And so, like, we're not. If it was just a US based program, maybe we can do that. So we have better data in our admissions process, but we typically don't ask these kinds of questions in the admissions process, honestly, because we're so international. So I'm not trying to like beat around this, but for example, we do have a report, and maybe we can put this in the chat, that we just looked at, for example, with women, because that's something that's very important. We are trying to get the asset class to be 50-50, for example. but that's about as far as we can go with some of this stuff. Um, are the types of LPs who invest in venture funds generally the same as those who invest in venture studios, or are there any differences? Um, yeah, it's a good question, Hannah. Like, first of all, like a lot of the venture studio funds are even smaller than like traditional venture funds, just because the studio is doing so much work there. But in general, what I see, at least in fund ones, whether it's a traditional fund or studio fund, it is going to be primarily high net worth individuals. So the answer is basically the same. Um, the studio has an even bigger friction point because you have to sort of justify the studio and why it makes sense to do this. It's kind of expensive to run a studio. So, but it's kind of the same, man. Like it's kind of the same type of LP, honestly, at the beginning. As you grow, though, where there's a big difference with studios, so you sort of proving yourself that this is a good studio, you start seeing a lot more corporate interest in studios than what I would say proportionally versus like funds, because then corporates can be like, ooh, the studio is building out the kind of companies that are helpful to our corporate innovation program. Or sometimes a bunch of corporates will put together, will build a consortium and fund a venture studio that's building companies that are helpful for their consortium. So you see what I would say a lot more corporate interest in studios than on a proportional basis. But at the beginning, you still have to kind of prove yourself. Okay. Okay. Europe is on track for the lowest fundraising year in a decade, not because capital disappeared, but because LPs are done funding inefficiency. The area of mega funds is over. The bar is high. The bar is higher and smarter. Do you agree? I don't know. I mean, I think the bigger issue in Europe, Rui, and we're dealing with this a lot right now, is not that as much as it is the over-regulation of things. Like I've been trying to solve the problems for you all to start funds in Europe, and it's so brutal. I mean, it literally costs 5 times as much to run a fund in Europe than it does in Delaware. You know, and the weird part about it is that it's not even like the service providers as much as it is all this weird regulatory stuff and all these requirements like audit and things like this that the jurisdictions have. And I'm trying to build partnerships and try to bring sort of the efficiency we've done in the US to places like Europe. But that is actually the biggest issue you have. You have like what I would say like a regulatory burden. And then the second thing about that is this concept of then you have this concept of like general solicitation that I've kind of been harping on people for today. It's really bad in Europe. Like you can go to jail, right? And so you need like UVECA and all this other stuff. And the third thing is that you have these like LPs that are just not optimal, like the EIF and stuff like that, that are very complicated to work with. And oftentimes when some of these LPs get involved, and I'm not going to name which ones, but when some of these LPs are involved, it makes it so that because of requirements, terms, or whatnot, the fund ends up underperforming in fund one. And if you end up underperforming in fund one, guess what happens? It's really hard to raise fund two. It's really hard to raise fund three. And so, the way that's done is not great either. So I say those three things are probably more bigger contributors to some of the challenges right now with like new VC firms getting started that are more nimble, that are going to go out and back all these amazing founders and stuff that are happening versus just like the fact that, oh, there wasn't like returns or something, okay. I don't understand your question, Nathaniel. So if you can just rewrite it, I would appreciate it. Okay. if I'm a founder, okay, who is interested in venture capital, what would you recommend to do as a rookie? Go to a venture institute. You know, like you're going to learn a lot about venture capital in venture institute. Great question from Peru. What are the best practices for keeping LPs updated? What's the frequency? What's the medium and stuff like this? You really want to have a newsletter, Peru, that you're sending out probably once a month, at the very minimum once a quarter. You're also going to want to do like events with LPs, like exclusive events. I don't know if you remember the slide I had with high net worth, especially. They want to be part of a community. So they're not just investing in for returns. They want to be like in a community. So, that's another way to kind of handle this too. And so usually I see people do at least like a quarterly event, and then every year they do what's called an AGM. It's like a big kind of fun update with as many LPs as you can. A lot of times these are in person, sometimes they're virtual. And so if you have that, you're going to do well. And if you treat your LPs super well in fund one, they're going to just keep coming back to future funds. And when you get into this like institutional DD, family office DD, they're going to try to figure out, hey, what percentage of my LPs in fund one, of your LPs in fund one, are coming into fund two anyway? So you really want a lot of them to re-up anyway. So treat them really well. Okay. Hey, Sergio. What are your thoughts on doing VIP dinners for family offices and high net worth as a way to build LP pipeline? That works really well, Sergio. In the perfect world, though, you're also maybe bringing some LPs that are currently committed to the fund. Maybe you bring a potential portfolio company or an ex-portfolio company as well to that. Because if you do that really well, then you don't even have to do any sales, right? Like you have a committed LP founder that you've treated really well and speaks the world of you, like, oh, I want to be part of this community, but they work really well. So yes, you should definitely do that. What are the do's and don'ts of working with placement agents? And this is related to fund two. In our experience, Sergio, they don't perform, and typically it's not a good use of time. I wish it was different, because it would really shortcut a lot of things. But placement agents tend to do better with very, very large funds, right? Like, I don't know, like they're going to an endowment and saying, hey, I've got Lightspeed Fund 25. It fits into your portfolio like this. To the people that they're pitching, there's like no risk, whatever, like it's Lightspeed or whatever, right? So they're just dealing with it that way. And they make a lot more money that way too when they know that they can do that. It's just so hard, even on a fund too, because it's still like a missionary thing. It's like they have to like find the perfect LP that, like Sergio, likes what you've done in your thesis in fund one. And it's like finding a needle in a haystack, right? So you end up seeing a lot of unqualified leads. You end up seeing a lot of like real estate people that don't understand venture and stuff like that. You see a lot of, if they're even successful. And a lot of times their model is suboptimal, right? They charge you right up front when they have a lead, and you're kind of on capital call, so it's really hard to budget for this. But historically, like we've seen a lot of people try this. We haven't seen much success on this, So what I would say is just tread lightly, interview them, say, hey, how many new managers and emerging managers have you worked with? Talk to them, see how they have helped, who their LP network is, where that's coming from, just so you can make sure that at least there's some overlap to your thesis. For emerging LPs who are unfamiliar with the asset class, does LP Institute offer a short half-day workshop, preferably free? Yeah, that's good. That's a really good one. I haven't really thought about a one-day workshop. We do, again, a program for this. And it is not that hard, but it is, there are so many concepts that we want them to see that, it does require more than one day. But another thing we've done that so if they sort of apply or put their name in, we also have LP matching where they get to meet a lot of GPs as part of this. So they'll learn quite a lot, but that's an interesting thing. But one thing that we have that's a little bit arguably better, but again, this is just my opinion, so I'll just go ahead and show it to you here. So maybe put this in the chat for everybody. So can you put the Decile Group AI in the chat here? So here you go, everybody. You can go here. And I'll just share my screen really quick so that everybody can kind of see this. So we've built out an entire like LP 101. So this is decilegroup.com/AI. So it's like learn to be an LP 101. Okay. And then you can select this, right? And then you can go ahead and, it'll talk to you about, how to do this. It's got a full on like curriculum. They can go in and click on the topics that they think are interesting. You can obviously ask any question into the AI and it sort of helps, right? And so that's kind of how we're dealing with this right now, and it's been very helpful. So you can go ahead and just send them that link. We do have a lot of issues with this, obviously, since we're so international. All right. Is there an optimal time to start a fund? Getting to principal or partner level? How does this change the domain focus biotech versus BaaS? Amy, the whole like apprenticeship career model in venture is not working and is no longer the way people start funds. In fact, it's actually very hard for you to spin out of a VC fund when you're a principal or a partner, because it's not your track record, it's the firm's track record. So then you have to get attribution to do that. So it's very complicated. So unless you already have the relationship with the LPs because of your work as a GP, this is how you sort of see this happening, where they come in and they sort of anchor you in your next fund. It's only because you've had those relationships. If you kind of rise the ranks to principal, even like some partner level, you might not even have access to the LP. So it's really hard to do this. So the better way to kind of do it is, and again, it's through a methodology like VC Lab, So, if you have a lot of like deal flow right now that's coming your way, that's, and you may want to consider doing this as a career, just join VC Lab. If you know people in your network that are high net worth individuals that, you could potentially fundraise from, join VC Lab. We have now products like Start Fund, where you can start a fund with as little as $150,000, and build that track record and start building out like a VC firm. I think I can't answer like the life decision. It's like kind of what should I do with my life, or when can I do this in my life kind of decision. That's a very deeply personal one. But as far as like the tool sets, the systems and everything, I mean, we've democratized this so much and lowered the barrier of entry so much. And it's all risk-free, right? Like VC Lab is free, Venture Institute is free, even Start Fund, is basically essentially free until you actually close on the money, right? And then that's when we start monetizing it. So, I mean, if you want to do this, and if this is something you want to do as a career for the next 10 to 15 years, just start now is my advice to you. All right. Since Europe is hard, would you consider less regulated markets like Armenia with access to Europe? I mean, I'm not sure what you mean by us considering it here. We have launched funds in Armenia before, and also just in general, like that region. And just because Europe is hard from a regulatory perspective, doesn't mean people shouldn't start funds there. People should definitely start funds there. So I'm not sure. Sorry, I don't understand the question. For successful funds that displayed power law and became unicorns, what was their LP architecture, archetype architecture? I mean, I'm pretty like we're not reinventing the wheel, team. Like when we say, hey, fund one should primarily be done with high net worth individuals that are in your network, that know you personally. This isn't something that we came up with. This isn't like a VC Lab innovation. This is how, I don't know, like unicorn funds, like lowercase capital fund one, right? That's like the most successful fund of all time, I think. Is pretty much all that type of profile individual, and so you just don't have the options. That's the problem, right? It's like the market's dictating it. Like I said, a lot of these bigger LPs just don't invest in fund ones or even fund twos, and very rarely fund threes. Again, there are differences. There are some like strategics and stuff like that, but yeah, that's about it. You know. Okay. You made a point about corporate investment for studios. Do you see these falling under institutional personas, or would you categorize them differently? Is there to help maximize interest with process? Yeah, I was debating that, Meyer. Like, should I just do an entire slide on corporates or not? I decided not to because I didn't want to have this presentation be like 30 minutes. I could go both ways. Corporates are different than a lot of institutionals because they invest for different purposes. That's the biggest thing. So a lot of times institutionals do invest for performance, maybe most of the time. Corporates often invest for other reasons, like corporate innovation and stuff like that. And so there's benefits and issues with that, right? Like the benefits are that it is they will sometimes come into fund ones or fund twos because if the initiative is strong enough, they'll do it, and when they do it, it's a lot of money, right? And so that's a benefit. Like the downside is that oftentimes that's not necessarily aligned with performance, and it's so critical for you to have high performance, especially in the first couple funds, so that you can build a career and have multiple funds moving forward. That could be a problem, right? And if again, you need to have maximum alignment of expectation across everything all the way through your limited partners. The second downside is that it takes a long time. It's like it is literally an enterprise sales process where you're selling the fund to solve some sort of problem or need that they have versus like I'm going to invest like this and perform like this. And you're going to need to be multi-threaded, just like in a typical like enterprise sales process, right? So you need to meet like the influencers, multiple influencers, like CEO, VP of this, VP of that. And if someone gets fired during a process, you kind of start over, right? And so they take like 1 to 2 years because of these issues, So again, there's pros and cons, What is the success rate of managers that have launched fund one and getting to a fund two or so through VC Lab? In VC Lab, it's extremely high, Ryan. I mean, I should have these numbers. I don't have them off the top of my head, but it's extremely high. The vast majority of people that close on a fund one and VC Lab end up doing a fund two. But part of the reason is because VC Lab prevented them from making a lot of stupid mistakes. So one of the things we see a lot is that people end up, one of the stupid mistakes that we see is that people like have too high targets, so they're like, I'm going to raise a $20 million fund one, and they end up getting 7 or getting undersubscribed, which 7 is a great outcome, but because it's undersubscribed, and it's because it's undersubscribed, like a lot of LPs are like, well, this is not the strategy you sold me, so I might back out and not make capital calls. Bad. Or you get to this next level of LP, and guess what? Like the analyst who's super risk averse is going to identify when they're doing their basic DD is like, oh, fundraising risk. They're not going to be able to go, and they have a hard time raising capital. So we'll just wait to see if they can raise more money, and then maybe we'll come in at the end, right? And so you can never be undersubscribed on fund one, right? And so what we've done in VC Lab is we just constantly push people to lower their targets to targets that can be oversubscribed, So that's what's happening here, So just as a FYI on that, All right, Natasha, what would it be possible to join the next cohort of VC Lab if I'm unable to raise in the current cohort? With India, timelines are longer as venture culture is younger. Yeah, absolutely. That's why we allow you to drop off. So no problem. Uh, do capital connectors work for helping get meetings booked with interested LPs? No, sorry. Like nothing that's got like some sort of economics on it. Uh, you know, nothing like that generally tends to work. They also don't have a lot of times your best interest in mind. It's kind of similar to the question we had from Sergio earlier about like, brokers. So just be very careful with this. Like you're going to use people for introductions, but it's never going to be for a fee. All right. Are there tax benefits in the US for being an LP? Yeah, but I'm not really a tax advisor, so I'm not going to be able to go ahead and um, give you advice on that. What about service providers as LPs, like your account, your bank account, strategic alignment as LPs checks to do business? Any conflict of interest you've heard of? What would be the ideal ask for them? Um, we've had law firms invest. That's fine. There's no, I mean, that's all group has a fund of funds. The thing is though, is that to do this right, Sergio, is you have to have they have to be able to manage the internal conflict of interest really well. So for example, what we do is that there's like a complete wall of separation between Desol Capital and the operating company for us. To the point where, Desol Capital can only get information if the manager from the Desol group, if the manager opts in to send it over there, because if you're an LP in Desol Capital, you may not, you don't want to invest if we're using the fund to get new business, right? That's super bad, right? That would be terrible. You want to invest in the fund that's performing the best, right? So there's a natural like wall of separation through conflicts, through policies, through all those different things. And so when a service provider does investments, like it'd be good if they had some level of that, I think. Otherwise, it could be an issue. Now, some people just invest off the balance sheet, and now we're sort of going into what I would call like the corporate realm. And then it's like for a strategic reason that they're investing in. And if they're investing for a strategic reason, the issue there is not as much conflict as like, does the strategy align with what you're trying to do as a fund? And so you have to sort of balance that. Do you have an example of a one pager that's easy to share via email with LPs? I don't feel comfortable in sharing a deck before meeting somebody, but at the same time, I do feel some LPs is something that more than one email. Look, if you know somebody really well, Ricardo, you really shouldn't have to share something ahead of time. They should just take the meeting, and you can talk to them about what you're up to. The more info you send people, the more reasons to say no. Even when you do a one pager, all a one pager is like a one page version of your deck. So if you have the deck, the easiest thing to do with your one pager is to take the key concepts or the key slides of your deck and kind of bring them into like the one pager. The base AI can help you with that a little bit too, by the way. You can ask it, and it'll give you some frameworks for how to do this. But from a strategy perspective, Ricardo, like again, you shouldn't need to do this unless you're pitching people that are super random that don't know you, and you're going to have a hard time converting them in a fun. And I'm not sure where you're at in the process, but you're going to have a hard time converting randoms. How is VC Lab able to support a fund focusing on capital intensive areas, example, biotech and deep tech? I mean, we've launched a ton of biotech and deep tech funds. We've backed a bunch of biotechs and deep tech funds with Desol Capital, Amy. The process of raising the fund, whether it's for biotech or others, it's the same. It's just the strategy is different. You're either going to make a lot more bets because they're going to have a higher probability of failure. This happens a lot if you're doing like pre-seed deep tech. If you're doing biotech and you're on the board of these companies or whatnot, which we've also seen, right, then you might do less. But the process is not different. So that's why VC Lab works really well, irrespective of this. And again, we power funds in both of these areas. We invest in funds in these areas. So I wouldn't worry about that part of it. I would just say that the program itself is very helpful, irrespective of the thesis. Which, by the way, and I know we've got 3 minutes here, we do have applications open for cohort 20 right now. So if you're interested, VC Lab is great, high 80s NPS, it'll get you to a close very, very fast. If you've been working with larger, more complex fund that is better suited for fund 2 or 3, would it work to launch this separately as a fund 1 and still keep both raising process going? Revi, I would do one. I would not be in the market with two funds. It might be better if you just go in and start a fund 1 and you will get more AUM faster, Revi, if you try to raise a really small fund 1 than if you try to raise a really large fund 1. Historically, again, there's exceptions to everything I'm saying. Okay, I don't this is not a rule, but you're going to just get AUM much faster, right? Because again, if you're a new manager, you're like a scarlet letter. Okay, don't back me, right? And so because you don't have any, and you don't have track record. Track record is you've managed other people's money professionally in a blind pool. So SPVs don't even count as track record. None of that stuff counts as track record. So you're doing a small fund 1, $1, $2, $3, $4, $5 million fund 1 that you then deploy very quickly, which would put you basically in raising fund 2 in a year from now, maybe even sooner. Right now, you can raise a much bigger fund 2 with bigger LPs, because you've de-risked it, because now you actually have track record. And then you get the fund 3 much faster versus you kind of banging your head against the wall for the next 2.5 to 3 years, trying to raise from these LPs that are mostly prevented by charter from doing that. And in the same amount of time, you're going to have 3 funds probably and more AUM in the next 3 to 4 years by raising a small fund than a big one. How small is a very small fund 1? Carolina, like I said, with Start Fund, minimum fund size is $150,000. Now, I think you should try to do more. I think for your sake, so you can make some money and get some fees and stuff like that, right? So I think you should target more, but that's how much we've lowered the barrier to entry to allow more people to get started. Venture capital has barely evolved in 40 years. What do you think is the next innovation in VC? I mean, AI is the next innovation in VC for sure. That's changed everything and how things work and how things get done faster. It's bringing costs down and stuff like that. So I think there's a huge component of that, but there's always going to be a need for humans because AI does not have a good ability for judgment. And a lot of this is still judgment, So that's it. And as far as the next business model, I don't think it's going to change that much, really. I think it's going to still be 2 and 20. It's not that there's not that much wrong with that right now. All right, everyone. I think we wrapped all questions done. It's really cool. All right, everybody. See you later. Cohort 20, apply. Love to work with you. Bye, everyone.